Hi there and welcome to Investors Guide. You're watching ET Now. I am Faye D'Souza. On this show, we try and help you make the most of your money by saving and investing it. I have two important things to talk to you about before we start the show. The first of which is Budget Day. Remember, the 10th of July has now been announced as Union Budget Day of this first government. Has been so exciting for all of us. Now, if you want to know how this budget will impact your money, you can do two things. You can watch the show at home between 7 and 8 o'clock on Budget Day. We'll be here with a big panel of guests and we'll explain everything to you. That's one way. The other thing to do is to come into the studio and be part of the show. You can be part of our audience and you can ask your questions live. All you have to do is reach us on the email ID that's at the bottom of your screen. You can also reach me on Twitter. We'll get in touch with you and tell you how you can come in and join the show. Secondly, if you've been watching the show for a while and we've been here for 270 weeks, if you've been watching us for a while and you've found the show helpful, get in touch with us or shoot a quick video and send it to us and we'll air it on the show. Let's get back to business. On the show this week, a special focus on NRIs will tell you how to invest and profit from India. In our product review, we'll look at the HDFC equity fund and tell you if you should stay invested. And we'll help employees of international companies understand their tax liabilities in India. All right, let me bring in Narendra, the CEO of Value Research. Narendra, thank you so much for joining us this week.
Thank you.
Let's get straight to our portfolio question. Princey Sonia has written in. She writes in from the Gulf, Narendra. She's 29 years old. Now, she's been working overseas for the last 7 years with a monthly take-home of 2.4 lakh rupees. Now, she saves 1.5 lakh rupees every month. That's close to 60% of what she makes, which is so impressive. She doesn't have a term cover right now, but she puts 75,000 rupees every year in the Jeevan Anand plan from LIC. This is interesting. A lot of NRIs who watch this show would have bought that plan because for some time, that was the only plan available to NRIs who wanted to invest in India. She tells us she's paid 6 premiums so far, but she's very unhappy with the plan and she wants to know if it's time to take her money out. Now, that's one question that she's asked us. She also has 20 lakh rupees in a fixed deposit, 30 lakh rupees in her savings account. She tells us she's considering buying another home of about 65 lakh rupees and she wants to know where she should invest her money in spite of the fact that there is some money going into her PF, where she should invest her money for her own retirement. Now, like most of the women who write in on this show, she tells us she's not very keen on taking on too much risk. She wants her money to be safe. Let's go goal by goal, Narendra. First of all, if she's someone with the kind of disposable income that she has, should she continue with her LIC policy?
It is entirely a matter of, her own situation. If she has dependents and financial dependents, then she needs to really worry about insurance. And this certainly isn't a great way of, achieving or deriving an insurance coverage just in case you're not around. So if you have financial dependents, consider a term plan. Maybe in Dubai you can buy even cheaper or more competitive a marketplace, and buying term plan there in that domicile might be easier and even cheaper. So that is the way to approach it. Don't combine insurance and investment, and this is not a great policy for you to have.
But then let's ask the next question. Now, she's written in saying that her father lost a lot of money when he invested in bad instruments, and she's worried about making the same mistakes right now. So she's really worried about taking on any risk. Now, we have to get her to understand, and this is really important, Princey, when your father picked the wrong instrument, it's not because it was a risky instrument or it was not. It was probably just not suited for him, and he probably just had really bad advice. So if you have good advice and you pick the right instrument, then the risk might actually suit you. So Narendra, 29 years old, so she's a young person. Although she's looking to come back to India in 5 years, that doesn't mean necessarily that she's going to retire in 5 years. What sort of an investment should someone like her choose?
No, one is that, she is fearful of assuming risk, and her own experience in the surrounding or her father's experience is something which is keeping her off. But there is another side to it. If you look at her portfolio, her current balances, 30 lakh rupees in her savings account, 20 lakh rupee in a bank FD, and she might be feeling happy that yes, this money is safe, but the money is only safe. It is not able to combat inflation. So important thing is that you have to assume risk if you want to beat inflation. That is the first benchmark. That is the first reference. You have to take risk in a measured way. You have to understand it. You have to approach it in a manner. And 2-3 rules is being followed. One is that diversify. Don't invest at one go. Don't invest lump sum. And save it in a manner and do it in a manner that you understand. Unless until you are able to reconcile with the plan that this is your emergency fund, this is your term insurance, and all the rest, rest of your savings is getting into something which is more productive and can beat inflation. And the way to achieve it for somebody like her will be a balanced fund or a growth and stable portfolio.
Right, our balanced fund is on your screen right now. It suits someone like you who doesn't want to take on too much risk. But for all of our viewers who are watching, I want to give you a very quick example. If you're someone who likes to leave your money in your savings bank account or even in a fixed deposit for long term, I want you to think back to every time you've heard a parent or a grandparent turn around and say, in my time 1,000 rupees was big money, or in my time 1 lakh rupees is big money. That's inflation. That's what inflation does to money. It was big money at one point. It's not anymore. You don't want your money 10, 20, 15 years down the line to seem like very little money. That's what happens when you leave it lying in your bank account, which is why you need to invest it in equity if you have any more than a 5 or a 6-year horizon for that money. And of course, like we keep saying on the show, consider again why you want to buy another piece of property if you already have one that's generating an income. It's not very liquid. You can't take the money out, and it's such a high maintenance investment. Think about that very carefully, and of course you can get back to us if you have any more questions about your investments. Let's take another question, Narendra. Ravi has written in. Now he wants to know if he should continue investing in the HDFC Premier Equity Plan A. He says with other plans like Mallya Blue Chip and Franklin smaller companies are doing so much better. Now, obviously, at this point, a fund like smaller companies is going to do better because we've seen mid-caps rally so much. But HDFC Premier Equity is not a bad plan. I wonder why he's so keen on giving up on it.
No, that's a problem. Most investors look at recent performance and they get carried by or tempted to invest in those. HDFC Premier Equity is not a small or a mid-cap fund by design. It is a tactical fund. It tries to capitalize on a specific theme at a given time, and that can change. So far, it has been, it has emphasized small and mid-cap stocks in its portfolio, and has done exceedingly well in a very difficult market. And it has been able to, do much better than most other funds in a struggling market. And now it's about to change track. It is beginning to change its track. With the changing economic environment or, the political climate, the way it has impacted our markets. So maybe add some more, but HDFC Premier Equity remains an impressive fund and a good fund to continue your investment.
Well, let's assume, Narendra, like most of the other investors who write into us, that he's a long-term investor and this money is going to stay invested for at least 5 or 6 years in the very minimum. He has HDFC Premier Equity Plan A. You said Franklin smaller companies might be a good complement to that. Is there any other fund you'd like to recommend to him?
Smaller company fund is the most impressive smaller company fund available, and it has done exceedingly well, and it never compromises on the quality. So that is something which is paramount in a small company, a fund which is focused on the smaller companies. So from that standpoint, it remains a great choice. But I would still urge an investor like him that don't get carried by short-term numbers. Try and invest in a fund which can invest across the market, and if at all you are, you find it very interesting and you think that, you can withstand the ups and downs of this, then maybe it can be, 10, 15, 20% of your total equity investment, but it should not be an equal allocation.
Over the next couple of weeks, we'll be tracking the budget for you on this show. You can come back and you can ask us questions if you'd like to. If you'd like to be part of the audience on Budget Day as well, write to us. Email ID is on your screen. Our team will get in touch with you and tell you how you can join us on Budget Day in the studio and ask your questions. There you are. Welcome back. You're watching Investors Guide on ET Now. It's time for our fund review. And this week, we're going to look at a fund that a lot of you have written to us and asked us about. That's the HDFC Equity Fund. It had a rough time over 2 years. Now it has begun to recover. Should you stay invested? Avan will give you those numbers first, and then we'll come back and talk about it. Avan.
Thanks, Faye. Well, this week we look at the HDFC Equity Fund. Now, this fund has enjoyed the longest track record and has demonstrated considerable skill while navigating through the different market conditions. It was launched in January 1995 and has given its investors a return of 21% since its inception. This large cap oriented equity fund invests 70% of its corpus in large cap and giant cap stocks and the remaining in mid and small cap stocks. In 2003, the fund management was taken over by Prashant Jain, and since then the fund has remained at the top amongst its category average. Jain combines a top-down and bottom-up approach to identify companies with strong balance sheets and business models. He sticks to his convictions, refusing to be swayed by market trends. His conviction in stocks like SBI and L&T, though, caused the fund to underperform in 2013. But this fund manager stuck to his guns. And it paid off. The fund recovered sharply this year, and the NAV went up 30% in the last 3 months, beating the benchmark and the category average by over 10%. But the number to focus on is in the long-term returns. This fund has given its investors an annualized return of 25% over the last 10 years. Let's take a look at some numbers to give you a better point of view. If you invested 1,000 rupees in this fund when it launched, you would have 29,347 rupees today. So should this fund be a part of your portfolio? Let's find out. With that, it's back to you, Faye.
Alright, Avan, thank you so much for those. Thank you so much for that information. Narendra, talking about the HDFC equity fund, it has an excellent long-term record. If we look at it over the last 10 years, it's one of the best in its category. 60% returns over the last year, which means that it has recovered quite sharply. Would you say the worst is behind it? All of the nervousness that we saw happen over the last 2 years, is that over now?
I think so, because, of course, last year was disappointing. It was a rough year for this fund. This fund, has always been ahead of the pack in its category. But that apart, last year it struggled. It was unable to beat its benchmark. And but it has more than recovered. And when we looked at it qualitatively, we checked with the fund manager. We understood the reason. We were told, we were informed that what is the thinking behind the approach in the portfolio, or why this belief, and that has come true.
Well, the convictions largely were in these three stocks: SBI, ICICI Bank, and L&T. Now, these stocks still add up to 20% of the total assets under management of this fund. 20% of the money that the fund is managing are divided among these three stocks. Is that still too much of a risk for investors who are watching? They probably say, okay, I've recovered right now. I've got my money back. Should I just take it and go?
No, it is not a worthwhile fight. It is not a worthwhile take, because, here is a fund manager who has been able to stick to his conviction. He has proved his mettle in the last 20 years. And it is not desirable to question him. And otherwise, too, I feel that, he has been proved right. There is an investment logic to it. And this fund has been contrarian and profitably. So we don't have a right to question him. Of course, the way I attribute the 2013 underperformance is that the fund kept away from something where most of the action was, or keeping away from very expensive FMCG stocks. So keeping away from some of those stocks and being in emphasizing some part of the market which was struggling. But that has been more than recovered. And I think, this is a fairly cheap fund given its underlying portfolio, and things change. We should not be questioning the fund manager given his history.
Alright, so excellent history gives us enough reason not to question this fund manager and his decisions. Let's give it a rating. The last time we talked about this fund, in 2013, you rated it 5 stars. Does it remain a 5-star fund then for you?
Yes, it remains one, and it remains an attractive fund. Of course, on a risk-adjusted scale, it slipped on the rating, and that caused a lot of anxiety for investors. But I think it is still a worthwhile fund, and has been able to prove its worth once again.
5 stars then for HDFC Equity on Investors Guide. Now remember, Narendra said if you're looking for a fund to invest in, this might be the fund for you. And of course, if you're already invested in this fund, then stay invested. Do not pull your money out unless you hear otherwise on this show and nowhere else. Let's move on now to our hold or sell segment. Sridhar Rao has written in our hold or sell segment. He's 40 years old, Narendra. He's been investing for his retirement since October 2010. He wants to know if his portfolio is on track. Right on top is the HDFC Top 200 Fund, 2,000 rupees going in every month. So if he's investing for his retirement, we're looking at 10, 15 years. Is this a good fund to pick for that sort of a target?
Yes, it has been an impressive fund, but I would say that, this fund is increasingly becoming little more large cap tilted. So what we were talking about, the HDFC equity is a better fund if you, or might be a better choice if you are looking at the kind of time horizon 10 to 15 years.
But the next fund on his list is the ICICI Prudential Discovery Fund, Narendra. Top of its category, great fund. Should he stay invested?
Yeah, I think, ICICI Prudential Discovery is a very impressive fund. And this fund also has a character. It is a value fund. It invests in out-of-favor stocks. And it has also, been able to prove its worth or its, standing in a full market cycle. It looks like the best performing fund today based on recent performance numbers, if you look at trailing returns. But more importantly, this fund sticks to what it says, and so it should be, he should hold it.
Hold that fund. I'm going to take the next two funds together, the DSP BlackRock Equity and the Reliance Regular Savings Equity Fund, 1,000 rupees each in this fund every month. Continue with these investments?
Yes, both funds are quite mediocre funds. They are average fund. Of course, they are impressive fund given, they are profitable funds. They have done reasonably okay in recent times. Also because, it can be reasonably attributed to the market turnaround. But DSP BlackRock Equity has been has not been as impressive as, it was 3 years back, 5 years back. And on a relative performance basis, I think there are superior alternatives for him to substitute this fund with.
Alright, so would you recommend one of those alternatives, Narendra, if he's going to exit these funds, and where would you like him to put that money?
Yes, I would suggest him to, be into funds which will remain diversified and they have good track record. Quantum long-term equity fund. Also, principal growth or something like Canada Robeco diversified equity could be reasonable choice.
Well, Dave has written in on behalf of his father, Narendra. His father is 65 years old and he invested 10 lakh rupees in a post office MIP, which will be maturing at the end of this month. He wants to know if he should reinvest that money in an MIP or if there are better options for him right now. He falls in a 30% tax bracket. Now, the post office MIP will offer him about 8.8% interest right now, which is taxable in his hands as a senior citizen. So for someone in the 30% tax bracket, would you recommend he considers other options right now which are better than the post office MIP?
A lot of investors think that, their money should be safe and it should produce income in their retirement. But they actually may not need that income, and it looks very likely that somebody in 30% tax bracket might not be, dependent on that income from that MIP investment. So if you're not heavily dependent on that, if you want your money to grow safely and remain liquid, then maybe, he should consider a stable growth portfolio or maybe even a conservative portfolio, which will be a better way to ensure that his money is inflation protected, is appreciating well, also reasonably liquid. If he is actually dependent on this investment for income, then there is one option which comes to my mind, which is in the secondary market, he will have access to the tax-free bonds issued by infrastructure companies. So if you invest in those, in the secondary market, it just might be yielding about 7.5%, ranging between 7.5% to 8%. And the interest income, the coupon income from those bonds is tax-free.
All right, so remember, if you have any more questions or you'd like to get in touch with us, there's an email ID, there's a Facebook page, and a Twitter account in which you can reach us. Narendra, thank you so much for answering our questions this week and spending time with us. Welcome back. You're watching Investors Guide on ET Now. Thank you so much for staying with us. We've brought in Suresh Surana again this week because we got so many questions from you about your taxes. Suresh, thank you so much for joining us. Our first question comes in from Sheila. Now, Sheila works for a US-based company that buys products from India, and she's based in India right now, but the company doesn't have an office in India. What they do is that they transfer $1,400 every month into her account as her salary. Now, she's aware of the fact that the company is not deducting any tax, and she has to pay income tax in India because that is where she's working. She wants to know how she should go about paying tax, Suresh, and who she should pay the tax to. So obviously there's a process involved here. Suresh is going to take us through it. Suresh, what should she do?
Yeah, so Sheila, first of all, it is necessary for your employer to deduct tax at source from your salary income because as an employer, you are having taxable income and there is an obligation on your employer to deduct the tax which is applicable. So you should discuss with your employer and hopefully then they will look into this aspect. But even if your employer is not deducting the tax at source, then the obligation is on you to pay the applicable tax by way of advance tax or self-assessment tax, and you compute your income. You can claim the deductions, of course, under section 80C or any other section which is applicable. And on the balance income, which is taxable, you pay the tax as per advance tax slabs which are applicable on 15th September, 15th December, and 15th March. So that would help you to fulfill your obligations under the income tax law.
Alright, our next question comes in from Jay Ramakrishnan, who has a similar problem. He works for an American-based company. He was allotted shares of that company under the employee stock ownership plan. And he tells us he wants to know if he needs to pay tax in India. His employer is already making deductions of 20% amount as tax in the States. He wants to know if he should also file this as part of his returns in the Form 16. Suresh, obviously, there is a very complicated treatment, unfortunately, of employee stock options in India. But what happens when those options are actually US-based? What should he do then?
Yes, Mr. Jha, you will have to offer this amount for taxation in India, and at the same time, you will be eligible to claim the credit for whatever your employer has deducted the tax. Just because the employer has deducted the tax, it does not mean that your reporting obligation is not there. You still need to report the salary income and compute the tax thereon and claim the credit for the tax deducted. So that's an obligation which is there, and you must file your return before the applicable due date.
Alright, last question on the show. Monu Matthew has written in. Now he's looking at selling property that he owns, and he's got a great deal of 65 lakh rupees as an offer for that property. He wants to know what he should do to avoid paying tax on that property. Suresh, 65 lakh rupees is what he's making. He hasn't told us what he bought the property at, which will actually determine whether it's long-term capital gains or short-term capital gains. Irrespective, what can he do to avoid paying tax?
So, in case you are selling the house property, you have two different options where you can claim the benefit. The first benefit is if you reinvest the capital gains in purchase of another residential property, then under section 54 of the Income Tax Act, you can claim the benefit of the exemption. For this purpose, you must purchase a new house within a period of 2 years from the date of sale, or 1 year prior to the date of sale, or alternatively, you must construct. In case you are constructing the house, then it must be constructed within the period of 3 years from the date of sale. In case your return is already due and you have not yet made the investment, then you can deposit the money in capital gains account scheme and use the money from capital gains account scheme for the purpose of purchase or construction of new house. The second option is under section 54 EC, up to rupees 50 lakh you can make investment in capital gains bonds, which are the NABARD bonds or National Highway Authority of India bonds, and that much amount will be then exempted. However, this will be subject to the lock-in period of 3 years, and therefore you need to consider that if you want to really purchase the house, then you must deposit in capital gains account scheme or make the investment before the due date of your return.
Alright, Suresh, thank you so much for answering those questions. Now, if you have a question about tax, write to us. Suresh will answer your questions for you, and we'll try and help you in every possible way. In the meantime, two very important announcements I want to remind you about. One is we want to know if you've been watching the show and you found it helpful. Record a quick video on your cell phone and email it to us. Email ID is on your screen right now. Secondly, Budget Day will be on the 10th of July. We'll have a special show like we always do in this studio on the 10th of July between 7 and 8 o'clock in the evening that will explain to you what the budget means for your money. You can of course watch the show, and if you'd like to come into the studio, be part of our audience and ask your questions, also write to us on the same email ID or reach me on Twitter. We'll get in touch with you and tell you how you can be part of that show. Thanks for watching Investors Guide. Stay with ET now.